Welcome to the Explainer. In trading, timing is, well, it's everything, right? So how do you spot when a market's about to turn around? How do you catch that bottom without getting burned? Well, today, we're going to decode a really powerful clue that can signal just that, and it's called the inverted hammer.
So here's what we'll cover. First, we're going to break down what this pattern actually looks like. Then, we'll get into the really cool part, the market psychology behind it. And after that, we'll get super practical, how to find it, how to actually trade it, and maybe most importantly, what its limits are.
Okay, so let's just dive right in. Look, every single trader on the planet asks the same question. When is this thing going to hit bottom, right? How do you get in just before it all turns around? Well, the answer isn't some big secret, it's a signal.
For centuries, traders have been looking for that edge. And a lot of the time, the answer is right there in the candlestick patterns. These were actually developed by Japanese rice traders way back in the 17th century. And you can think of them as a kind of visual language, one that shows you the whole emotional battle between buyers and sellers, all packed into one simple shape.
All right, so let's really break down the pattern we're talking about today. What exactly is an inverted hammer made of?
Okay, so in simple terms, the inverted hammer is just a single candlestick, and its job is to signal a potential bullish reversal, which is just a fancy way of saying the price might be about to head up. It only counts if it shows up during a downtrend, and when it does, it's like a warning shot to all the sellers who've been running the show.
So it has three distinct parts you got to look for. First, a really small body. That just means the opening and closing prices were super close together. Second, a long upper wick. And I love this. It's like the ghost of a rally that the buyers tried to start. And finally, you'll see little to no lower wick at all. That tells you the sellers just couldn't push the price any lower.
Now here's the rule that really makes it official. It's a simple one. That upper wick has to be at least twice as long as the body. It's not just a suggestion, it's the rule. And that very specific ratio is what gives this whole signal its predictive power. And get this, even the color of that tiny little body tells a story. It tells you who won the very last fight of the session. So if the body is green, that's a much stronger sign. It means the buyers actually managed to close the price higher than where it started. But if it's red, well, that means the sellers clawed back some control right at the end. It's still a valid pattern, for sure, but you might want to be just a little more cautious. So you might be wondering, why does this one little shape matter so much? Well, it's because it's not just a shape, it's a story. It's a picture of the market's psychology, a snapshot of a major power shift. Okay, so here's what's really going on when you see this pattern after a long downtrend. First, you've got seller exhaustion. The bears are just running out of steam. Second, you're seeing real buyer interest for the first time in a while. The bulls are dipping their toes in the water, and that's what creates that long upper wick. And third, it's an unresolved battle. Yeah, the sellers push the price back down, but that initial surge of buying, that's the real headline.
It's really like that classic tug of war, the one between optimism and pessimism. For a while, the pessimists, the sellers, have been dragging the rope their way. But this pattern, the inverted hammer, it's the first sign that the buyers are finally digging their heels in and starting to pull back.
Okay, so now you know what it looks like, and you get the psychology behind it. But here's the thing. Just spotting the shape is only half the battle. If you really want to use this thing effectively, you have to remember one crucial word: context. Context is absolutely everything.
So what kind of context are we talking about? Well, there are three big ones. First, location. It has to show up at the bottom of a downtrend. If you see this shape anywhere else, it means something totally different. Second, conviction. You want to see a spike in trading volume when it appears. Why? Because high volume means big money is behind this potential shift. And third, history. The signal gets way more powerful if it forms near a known support level. That's a price where buyers have jumped in before.
All right, let's get down to the nitty-gritty. How do you actually trade this thing? Because the key isn't just spotting the pattern, right? It's about having a solid, disciplined plan for what you're going to do next.
So here's a simple three-step approach. And listen, a smart trader never jumps the gun. So step one is all about patience. You wait for the next candle. You need to see a strong bullish move up to confirm the signal. Step two is your entry. You could enter the trade once the price moves above the high of that inverted hammer. And step three, this is the most important one, is risk management. You always place a stop loss just below the low of the hammer. Think of it as your safety net, your escape hatch, in case the whole thing goes south.
Okay, this is super important to remember. The inverted hammer is a tool. It's a high probability clue, but it is not an oracle. It's not a guarantee. The best way to think about it is like a weather forecast. It tells you there's a good chance of sunshine, but it's not a crystal ball.
And yeah, we have data on this. Backtesting shows that even if you do everything right, you wait for that confirmation candle and all, the pattern works out about 60 to 70% of the time. Now that's a really solid edge, but it also means it fails 30 to 40% of the time. And that right there is exactly why that stop loss we just talked about is absolutely non-negotiable.
You know, there's a classic mistake that a lot of people make, and that's confusing the inverted hammer with its evil twin, the shooting star. Seriously, they look exactly the same. But like we said before, context is king. The inverted hammer, that shows up in a downtrend and hints that the price might go up. The shooting star, it's the opposite. It shows up in an uptrend and warns that the price might go down. Same shape, completely opposite meaning, and it all comes down to where you find it.
Okay, so let's just hammer home the big mistakes to avoid. Number 1, don't ever rely on this pattern by itself. It's just one piece of the puzzle. 2, never ignore the context of the broader market. 3, always, always, always use a stop loss to manage your risk. And 4, don't be impatient. Wait for that confirmation candle before you even think about making a move.
So at the end of the day, the inverted hammer is just so much more than a shape on a screen. Think of it as a whisper from the market, a little hint that the tide could be about to turn. It's a clue, not a command. It gives you a potential edge, but it definitely doesn't give you a guaranteed answer. So the real question for you is, how are you going to listen to it?